Hello, welcome to this session. My name is Leroy Meadows, and I want to thank you for joining me. And in this session, we're going to be working out exercise 9-21, dealing with the difference between variable and absorption costing. So let's go ahead and get started here, and let's read the problem. NASCAR Motors assembles and sells motor vehicles and uses standard costing. Actual data relating to April and May 2017 are as follows. And then we have the beginning, we have the data for April and May, our beginning inventory and the number of units, production, and then sales. And then we actually have a breakdown of costs by their behavior, variable costs, as far as manufacturing overhead costs per unit and operating or marketing costs per unit sold. And then we also have a breakdown between manufacturing and operating costs for fixed costs. The selling price per vehicle is $24,000. The budgeted level of production used to calculate the budgeted fixed manufacturing overhead cost per unit is 500. So this is how many units we're budgeting to produce, not how many we're actually going to produce, because we see production is different than what we budgeted up here. So, but our budgeted manufacturing cost per unit is based on production of 500 units. There are no price, efficiency, or spending variances. Any production volume variance is written off to cost of goods sold in the month in which it occurs. And the first thing we're asked to do is prepare April and May 2017 income statements for NASCAR Motors under A, variable costing, and under B, absorption costing. And then the second part that we're going to do is prepare a numerical reconciliation and explain the differences between operating income for each month under variable costing and under absorption costing. So let's go ahead and get started. The first thing we want to do is take a look at our key inputs here, and we want to see how many units we're going to have in beginning inventory, production, and so forth. So let's go ahead and take a look here. Our beginning inventory, we see that we have no beginning inventory for April and 150 units for May. So let's take a look here. And we have no beginning inventory for April. We are budgeting 500 units for production. So how many units am I going to have available for sale? Well, I'm going to have 500. And then I'm going to subtract out the number of units sold, or I'm expecting to sell 350 units. So that leaves me with 150 units in ending inventory for April. Now let's go ahead and look at the units for May, the unit data for May. Now remember, ending inventory for April is going to be beginning inventory for May, so I'm going to have 150 units in beginning inventory. Now, based on not budgeted, because I want to look at, I'm only using budgeted numbers to calculate the fixed manufacturing cost per unit. But how many did I actually produce in May? Well, I actually produced 400 units. So how many motorcycles, or how many motor vehicles do I have for sale? Well, I have my beginning inventory plus my production, so I have 550 units available for sale. Now, how many did I sell in the period? Well, how many did I sell in May over here? It tells me 520. So I have an ending inventory at the end of May, 30 motor vehicles. So now that I know that, I'm going to move on now to figuring out my absorption cost per unit. I know my variable cost per unit my cost per unit under variable costing. Why? Because it gives me variable cost, manufacturing cost per unit, 10,000 and 10,000 for each month of April and May. So I know those are my variable manufacturing cost per unit. But I want to know my total manufacturing cost per unit under absorption costing, because remember, variable costing only includes variable manufacturing cost per unit, whereas under absorption costing we include fixed manufacturing cost per unit. So let's go ahead here and figure out our total manufacturing cost per unit under absorption costing. So we need to take into account fixed manufacturing costs. Now, how many fixed manufacturing costs am I going to incur in April and May? Well, I'm going to incur $2 million of the cost. So I'm going to take $2 million. Now, how many units am I budgeting to produce? Well, I'm budgeting, it told me here, I'm budgeting 500 units per month. So I'm going to take that 2 million and divide that over 500 units per month. And when I do so, what am I going to get for cost per unit? $4,000 for fixed manufacturing cost per unit. Now I'm going to add to my fixed manufacturing cost per unit my variable cost per unit, and I saw that over here, my variable manufacturing cost per unit of 10,000. So what are my total manufacturing costs per unit under absorption costing? The total of fixed manufacturing cost per unit plus variable manufacturing cost per unit, and that gives me $14,000. Now, let's take a look at absorption costing per unit for May. Now, in May, I expect to incur $2 million worth of fixed manufacturing costs. So I'm going to go ahead and just put that here. Oops, forgot a zero here. And how many units am I budgeting to make in May? We're told that in the problem here, we're budgeted to make 500 units. So I'm going to spread that 2 million over 500 units. And what do I get? I get $4,000 of manufacturing costs, of fixed manufacturing costs per unit under absorption costing. And do my variable manufacturing costs per unit change between April and May? No, they don't. So I'm going to use the same 10,000. And so my manufacturing cost per unit, my total manufacturing cost per unit under absorption costing is going to be exactly the same under both months. So now that I've got my total manufacturing cost per unit under absorption costing, and I know my variable manufacturing cost per unit is just simply 10,000 here. So now we've got the difference in cost per unit. Now we can do the absorption costing income statement and then figure out our operating income, and then we can figure out our operating income under absorption costing. So we're going to do variable costing first and then absorption costing. Remember that under variable costing, we're going to use a contribution margin format income statement to compute our operating income because we want to look at things by behavior, and that's what variable costing does. Then under absorption costing, we're going to look at it as how those costs are characterized as far as, or classified as far as product or period costs. So now let's go ahead and compute our operating income under variable costing for both April and May. So we're going to begin with calculating the revenues. Now, it's important to note that no matter which method we use to compute operating income, whether it's variable costing or absorption costing, the dollar amount of revenues is going to be the same. Why? Because we're taking our actual selling price of $24,000 times the actual number of units sold. So the selling price does not change. There's no special computation. There's no differentiation between variable costing and absorption costing. So let's see. So we'll take the number of units sold, and in this case, I sold how many units? 350 units. So let me get my calculator out here. Hold on. Okay, so I'll take my 350 units sold times my selling price of 24,000, and in April, I'm going to have sales or revenue of 8,400,000. So now let's take a look at variable costs. How many units do I have in beginning inventory? Well, I had up here no units in beginning inventory, so there's nothing to compute there. Then I have my variable operating cost per unit, or I want my variable manufacturing cost per unit. Let's see. Hold on. Okay, so here we have our variable manufacturing costs. What are my total variable manufacturing costs? Well, my variable manufacturing costs are going to be the number of units produced, or the number of units I incurred and made, 500, times the variable manufacturing cost per unit. So when I take 500 and multiply that by $10,000 of variable manufacturing cost per unit, I'm going to get $5 million in manufacturing costs. So let me put that here. So what is the total cost of goods available for sale? Remember, the cost of goods available for sale is always my beginning inventory plus the cost I incurred for the period. So in this case, beginning inventory of 0 plus variable manufacturing costs give me cost of goods available for sale of $5 million. And then I'm going to deduct my ending inventory here, and let's see. I should not have typed that as beginning inventory, less ending inventory. So how much in ending inventory do I have? Well, I had ending inventory of 150 units, and a variable manufacturing costs are $10,000 per unit. Then in ending inventory, I have what? I have $1,050,000. And that's simply 150 times 10,000. Actually, that's 1.5 million. There we go. Okay. So what are my variable cost of goods sold? Under variable costing, my cost of goods available for sale minus my ending inventory under variable costing, which is 1.5 million. So my variable cost of goods sold is $3,500,000. Okay, so what were my variable operating costs? Well, I'm told here that my variable operating costs are $3,000. And those, remember, operating costs are different because those are not product costs or manufacturing costs. Those are overhead type costs. It's for administrative and general selling and administrative costs, things like that. So how much in cost did I incur for variable costs for the month for operating costs? So my variable operating costs are simply going to be $3,000 per unit times the number of units sold. So if I take 350 times $3,000 per unit, I'm going to have $1,050,000 as far as variable operating costs per unit. So what are my total variable costs? Considering, because I now have separated the variable costs by manufacturing and by operating costs. So now what are my total variable costs? My total variable costs are going to be my variable cost of goods sold plus my variable operating costs. So if I add those together, I'm going to get my total variable cost of $4,550,000. So now how do I calculate the contribution margin? My revenue minus my total variable costs. And when I do that, what do I get for my total variable costs? I'm going to get contribution margin rather. Contribution margin is going to be $3,850,000. Now, let's take a look at fixed costs, both manufacturing and operating costs under variable costing. Remember, under variable costing, all fixed manufacturing costs are expensed off in their entirety because we're treating them as a period cost. So I'm going to just, under variable costing, I'm going to expense the whole $2 million, and then as well as the full $600,000 worth of operating costs that I see over here. So what are my total fixed costs for the period under variable costing? $2,600,000. And whoops, I hit subtract instead of add. There we go. So now, what do I have under operating income for variable costing for April? I have my contribution margin minus my total fixed costs, and that gives me how much? Contribution margin minus my total fixed costs will give me operating income of $1,250,000. Now, let's go ahead and do May real quick. May, what are my total revenues for May? Well, how many units did I sell? Well, I sold 520 units, so I did a lot better in May than I did in April. So May, I'm going to take my $520, or 520 units sold times what was my selling price per unit? $24,000. And that gives me what? $12,480,000. So $12,480,000. Now, let's account for my variable cost of goods sold. I have what in beginning inventory? I had how many units in beginning inventory? Well, I had up here 150 units. Under variable costing, I'm just going to take my beginning inventory of 150 and times that by the variable manufacturing cost per unit, which is $10,000. And that gives me what? $1,500,000 in beginning inventory. Now, how much in variable manufacturing cost did I actually incur in the period? Well, I actually produced 400 units. So I'm going to take my 400 units and multiply that by my variable manufacturing cost per unit, and that would give me $4 million. So what are my cost of goods available for sale? Again, my cost of goods available for sale is always my beginning inventory plus variable manufacturing costs. So when I add those two up, I have $5,500,000 in cost of goods available for sale. Now, how much do I have in ending inventory? Well, I have an ending inventory 30 units. We figured that up here for May. Ending inventory units 30, and then times $10,000 per unit. And that gives me how much? Well, I have an ending inventory $300,000 under variable costing. So what is my variable cost of goods sold under variable costing here? Cost of goods available for sale minus ending inventory. And when I do that, I get what? My variable cost of goods sold, $5,200,000. So now I've computed the variable cost of goods sold component. Let me figure out my variable operating costs so that I can add the two together and figure out my total variable costs. Now my operating cost per unit is what? $3,000. And we got that right here. $3,000 times the number of units sold, because I actually incurred those for only the unit sold, which is 520. So I'll take 520 times $3,000, and my variable operating costs are what? Let's see, $1,560,000. So what are my total variable costs? My total variable cost is going to be simply the sum of my variable cost of goods sold and my variable operating costs. And when I add those together, I get what? $6,760,000. So what is my contribution margin then? Revenues minus my total variable costs, and that gives me $5,720,000. Okay, now let's take a look at our fixed costs. Again, according to the information here, I have $2 million in fixed costs, and then I also have operating fixed costs of $600,000. So those did not change. So what are my total fixed costs? Fixed manufacturing costs plus fixed operating costs, $2,600,000. So operating income under variable costing then is going to be what? Contribution margin minus my total fixed costs, and that gives me what? $3,120,000 of operating income under variable costing. Now let's take a look at computing our operating income under absorption costing. And under absorption costing, remember, our full manufacturing costs per unit are $14,000, not just the $10,000 of variable manufacturing cost per unit. Why? Because we're looking at fixed manufacturing cost per unit in addition to variable manufacturing cost per unit. So under absorption costing, our product costs are going to be $14,000 per unit. So now I'm going to bring this down here a little bit so we can relate to the amounts here. And let's take a look at our revenues. Now remember, we said that no matter which costing method we're going to use, it's not going to affect revenues. Why? Because the sales price per vehicle times the number of vehicles sold is going to be the same. There's no difference between the two. So I'm just going to get the information from up here. $8,400,000, and I'm going to do that for just both April and May. And we'll just go ahead and do that now. So now, let's take a look in computing our cost of goods sold. Now, I could just take my cost of goods sold manufacturing cost per unit times the number of units sold. But why are we doing this here and breaking this down and computing it? Because one, we want to be thorough and see exactly where all of our costs were incurred. Then we want to be able to compute also the individual components. What about beginning inventory? What about cost of goods available for sale? What about ending inventory? How do we compute that? So if we can so that's why we're breaking this down. We're being a lot more detailed. I could have taken a shortcut and just taken $14,000 times the number of units sold and got my cost of goods sold that way. But I want a lot more detail. I want to get a little more information and see how things are moving. So my beginning inventory, remember we had no beginning inventory, so I'm going to have 0 there. And so I have no allocated fixed manufacturing costs. So now let's take a look at our variable costs here. Then beginning inventory should have actually been 0 up here. Variable manufacturing costs were what? $10,000 times 500 units produced. So that gave me how much? That gave me $5 million. And we actually computed that up here. But now, in addition to that, I'm going to allocate my manufacturing costs. My actual production this time around was 500 units. We see that up here. So it matched my budget, and my production actually matched. So I'm going to have allocation of $2 million. So my cost of goods available for sale is going to be how much? Well, simply my variable manufacturing costs incurred plus my allocated fixed manufacturing costs. So that's going to be what? $7 million. Now I'm going to subtract out my ending inventory. And what is my ending inventory? It's simply going to be what? I had 500 units produced. I only sold 350. So how many units do I have in ending inventory? We computed that up here, and that was 150 times the full manufacturing cost per unit of $14,000. So I'm going to take my $14,000 times 150 units in ending inventory, and that's going to give me an ending inventory of $2,100,000. Now, since I have no beginning inventory, I have no production volume variance here. So I'm just going to simply put 0 here. So what is my cost of goods sold? My cost of goods sold is simply going to be what? My cost of goods available for sale minus my ending inventory minus my unfavorable or plus my favorable adjustment for production volume variance. So equals 7 million minus 2.1 million. My cost of goods sold under absorption costing is going to be $4,900,000. Now again, I could compute my cost of goods sold a different way. I could have taken the number of units sold, 350, and multiply that by the full manufacturing cost per unit under absorption costing of $14,000, and I would have gotten the same amount here. So again, I'm doing this for additional level of detail. That's primarily what I'm doing. And then that way I can also figure out my ending inventory that's already in here, so I can just get my level of detail here. And that's why we're doing this way. So now let's take a look at our operating. So what's my gross margin first before we get to operating costs? My gross margin is simply revenues minus my cost of goods sold under absorption costing. And so what's my gross margin? My gross margin should be $3,500,000. Now, let's take a look at our operating costs. My variable operating costs are what? $10,000 per unit times the number of units sold, and that is how much? So 10,000 times the number of units sold, and that would be what? What was it? $1,050,000. And what were my fixed operating costs? My fixed operating costs were $600,000. So what were my total operating costs for the period? Because again, remember, we separated product up here, and now we're doing our period costs. So my period costs are what? $1,050,000 plus $600,000 gives me $1,650,000. So what is my operating income under absorption costing? Well, it's simply going to be gross margin minus my total operating costs. So my gross margin minus my total operating costs is going to give me $1,850,000 of operating income. Now, let's take a look here, and let's go back now to May and figure out the detailed information for May. Now remember that my ending inventory here is my beginning inventory for the next month. So I can actually just reference that cell here to give me my beginning inventory. Now let's take a look at our variable manufacturing costs. And our variable manufacturing cost is going to be the number of units produced, 400. So I'm going to take my 400 and multiply that by the variable manufacturing cost per unit produced, $10,000. And that gets me $4 million. So variable manufacturing costs during the period, $4 million, plus my allocated fixed manufacturing costs. Now here I want to determine how much of my fixed manufacturing costs did I allocate. Well, I figured an allocation of what? $4,000 per unit of fixed manufacturing costs, but I only produced 400,000 or 400 units. So $4,000 per unit times 400 units produced, and let's go ahead here, 400 times 4,000, and that gives me allocated fixed manufacturing costs of $1,600,000. So what are my total cost of goods available for sale? My cost of goods available for sale is simply my beginning inventory plus my full manufacturing costs. And that is what? $7,700,000. Now, let's deduct the ending value of the value of my ending inventory. And what's the value of my ending inventory? $14,000 per unit times the number of units in ending inventory, and we've had 30 units in ending inventory. So if I take my $14,000 times 30 units in ending inventory, and I'm going to have $420,000 worth of ending inventory. Now let's take a look here at the adjustment for production volume variance. And this is simply going to be the difference between the the full fixed manufacturing cost of $2 million minus the amount of allocated fixed manufacturing overhead. So I had incurred $2 million of fixed manufacturing costs. I only allocated $1.6 million. So I underallocated by $400,000. Now, how do we treat this as so is that favorable or unfavorable? First of all, it's unfavorable. Why? Because I did not allocate enough fixed manufacturing overhead. So when I have an unfavorable, I am going to further reduce I'm going to add that to my cost of goods sold rather. So I'm going to take rather my cost of goods available for sale minus my ending inventory, but then I'm going to add back in my production volume variance. Because it's unfavorable, I'm going to add that back in, not subtract it. I'm going to add that back in to my to compute my cost of goods sold. So my cost of goods available for sale minus my ending inventory, either plus an unfavorable production volume variance or minus a favorable production volume variance. In this case, it's unfavorable, so I want to add that in. So that gives me my cost of goods sold of $7,680,000. So what is my gross margin here? Or my gross margin is simply going to be revenues minus my total cost of goods sold after the production volume variance. And that's $4,800,000. Now, let's take a look at our operating costs. Our variable operating costs are going to be our variable operating cost per unit, $3,000, times the number of units sold, which is 520. So in this case, it's going to be what? It is going to be $1,560,000. Now, my fixed operating costs. Remember, fixed costs, we deal with it in total. Fixed operating costs are expensed off in the period they're incurred, no matter which costing system, because it's an operating cost. So I'm going to expense that off at $600,000. Oops. There we go. So what are my total operating costs for the period under absorption costing? My variable overhead costs plus my fixed overhead or fixed operating costs. Variable operating costs plus fixed operating costs. And that gives me total operating costs of $2,160,000. So now how do I compute operating income under absorption costing? Simply going to take my gross margin, which is what? $4,800,000, and subtract from that my total operating costs, and then I have operating income under absorption costing of $2,640,000. Now we see the difference in operating income, and let me just bring this up here. We see under variable costing here, my operating income under both months is different. And again, why is that? Because we're treating fixed manufacturing costs differently under variable costing as we do under absorption costing. Under variable costing, fixed manufacturing costs are expensed in their entirety, no matter what beginning, ending inventory is, because under variable costing, we're considering that a capacity-related cost, so we're going to expense that off in its entirety. Under absorption costing, fixed manufacturing costs, just like variable manufacturing costs, will end up in inventory first and only expensed off as units are sold. So now let's take a look and do part 2, do a numerical reconciliation and explanation of the difference between the operating income for each month under variable and absorption costing. So let's take a look at the difference here. And you will see this formula in the book here. So let's go ahead and use this formula here. Absorption costing operating income. Let's go to 2017 real quick, or for April rather, of 2017. Absorption costing income, operating income minus variable costing operating income, and we see that we had a difference of $600,000. And again, why is that? That was because the way we treated fixed manufacturing costs. In variable costing, we expensed off the full $2 million. Under absorption costing, we only expensed off the fixed manufacturing cost per unit times the number of units sold. And that is also, if we account for that in the difference between fixed manufacturing costs and ending inventory minus fixed manufacturing costs and beginning inventory. In this case, we had nothing. So now let's take a look at this for May. In May, our absorption costing operating income was what? $2,640,000. And we subtract from that our operating income under variable costing of $3,120,000. And that's a difference of $480,000. And how do we account for that? We simply take the fixed manufacturing cost per unit of $4,000 and then multiply that by the difference between the 30 units in ending inventory and the 150 units in beginning inventory. And that gives us our same thing as well. And again, that difference there is just simply how we treat fixed manufacturing costs. And it's important, as we talked about in our instructional video and in our discussion, that for various reasons we may want to separate those for pricing and product mix decisions, for performance analysis and so forth, since mid and lower level managers may not have any control over fixed costs. So we want to only judge them on variable costs and so forth. And then there's also, we talked about producing for inventory. As far as if sales are matching the increase in production, that's great. But if they're not, if our sales are staying constant and we're constantly adding inventory, our balance sheet's going to get bloated with inventory. And so we need to know what the difference here so that we can make adjustments to our variable costs so we're not getting the system gamed. So, but this is exercise 9-21. It was a little bit longer, and I took a little bit longer because I wanted to explain the different things here. But again, we can compute our cost per unit times the number of units sold to get our cost of goods sold. Why do we do this? For a lot higher level of detail here. But if I want my cost of goods sold, and I'll just put this up here, equals under variable costing is going to equal variable manufacturing costs per unit times the number of units sold, cost of goods sold under absorption costing is simply going to equal full manufacturing cost per unit times the number of units sold. So there are two main computations that we did not see in a previous chapter. It's cost of goods sold, separating it by variable costing and absorption costing. We were familiar with absorption costing because that's really what we did before. Everything up into this chapter. But for cost of goods sold under variable costing, we just want to look at variable manufacturing cost per unit times the number of units sold. And again, I can do that with ending inventory as well. My ending inventory under variable costing equals variable manufacturing cost per unit times the number of units in ending inventory. And then ending inventory under absorption costing will equal full manufacturing costs per unit times the number of units in ending inventory. And remember that full manufacturing cost is equal to variable manufacturing costs plus fixed manufacturing costs. And again, we're looking at full manufacturing costs. In this instance, I'm looking at the on a per unit basis here. So, okay. Thank you for joining me. This is Leroy Meadows. Thank you for joining us in this session with this exercise. Have a good day.